Hi everyone, we're going to go ahead and go through some examples of various journal entries, and this will also help you with the homework for Chapter 13. But Bob Company issued 1,000 shares of stock, and we're going to prepare the entry for the issuance under various different situations. So the first situation, the stock has a par value of $1 per share and was issued for a total of $10,000. Well, the first thing, let's figure out if they issued the stock for $10,000 and we know we issued 1,000 shares, we can easily figure out what we issued it for per share. So $10,000 divided by the money that was received divided by the 1,000 shares equals $10 a share. So that's how much it was issued per share. So the journal entry we're going to go ahead and make is debiting cash, 10,000, crediting common stock for the par value. Well, we know we issued 1,000 shares. Our par value is $1 per share, so we're going to credit the common stock for 1,000. And then we're going to credit an account paid in capital in excess of par value. I'm just going to call it in excess of par. And we're going to credit that for the difference. So 10,000 minus 1,000 is 9,000. The next question is the stock had a stated value of $1 per share and was issued for a total of 10,000. Well, it's basically the same entry, except instead of the word par, we would use the word stated. So it would be paid in capital in excess of stated value. Next one, stock had no par or stated value and was issued for $10,000. We're going to go ahead and debit cash for 10,000. Go ahead and credit common stock for 10,000. The next one, the stock had a par value of $1 per share and was issued for equipment worth 10,000. Well, in this case, it's not a non-cash transaction, right? So we need to put it into a cash equivalent. And the way we do that is we have to either look at the fair market value of the consideration we're giving up or the fair market value of the consideration that we are receiving. In this case, all they tell us is the stock had a par value of $1 per share. So that doesn't tell us the fair market value of the stock. But we are told that the equipment was worth $10,000. So since we know the value of the equipment, we're going to go ahead and go with that $10,000 figure. So we're going to go ahead and debit equipment for 10,000, credit common stock for that $1,000 per share for the 1,000 shares, so that's $1,000, and credit paid in capital in excess of par value for the 9,000. Okay. Next one, the stock had a par value of 1 and was issued to consultants for services during incorporation, valued at $10,000. There's no established market price for the stock. So again, if the stock had a par value of 1 and we don't know the market value, that's the consideration we're giving up. We're going to have to the fair market value, instead of looking at the fair market value we're giving up since we don't know it, we're going to have to look to the fair market value of the consideration we're receiving. So in this case, we know the value of those services were $10,000, and this was to set up the organization. So this is considered an organization expense. So we're going to go ahead and debit organization expense for $10,000. We are going to go ahead and credit common stock for 1,000. $1 per share, $1 par value for 1,000 shares is $1,000. And we'll go ahead and credit paid in capital in excess of par value. Just right in excess of par for 9,000. I do want to stop you here while I'm thinking of it. I believe in the homework, I don't know, I think, be careful on how they want you to list these credit entries. I think they want you to do it from the largest dollar volume to the lowest. I don't remember, but make sure you read that carefully in the homework. I can't remember how they want you to list the credit entries, but make sure you follow their instructions. And let's see what else we have. The next item we have, Bob issues 1,000 shares of common stock to acquire equipment that was recently advertised for sale at $12,000. The stock had a par value of $1 per share and is actively traded at $10 per share. Okay, so in this case, we know the value, the fair market value of our stock, right? It's telling us the fair market value of the stock. It's actively trading at $10 per share. What we don't know is the fair market value of the equipment. All we know is the price it was advertised for. So we're going to go ahead and use, in this case, the fair market value of the consideration that we are giving up, which is the stock. So let's go ahead and record that entry. We're going to go ahead and record again. We're receiving equipment. So we're going to debit equipment for $10,000. $10 per share, or $10 per share times 1,000 shares is going to be $10,000. So that's where we get the value of the equipment. We'll go ahead and debit equipment for the $10,000. Go ahead and credit common stock for $1,000. $1 per share par value times 1,000 shares. Go ahead and credit paid in capital in excess of par value for $9,000. Last one is preferred stock. So in this case, Bob Company issues 1,000 shares of $50 par value preferred stock for cash at $60 per share. So what I'm issuing here, or what I'm receiving I should say, is cash for $50 per share times 1,000 shares. That's going to be $50,000. I'm going to debit my cash. I'm going to credit preferred stock for the par value. Oh, I'm sorry, excuse me. The cash we received, I'm sorry, I almost made a mistake. Let me go back and look at it again. Cash we received was, $60 per share. So $60 per share times 1,000 shares is $60,000. So the cash, cash I received, we're going to debit for that $60,000. The par value of the preferred stock is $50 a share. $50 a share times 1,000 shares is going to equal $50,000. So I'm going to go ahead and credit preferred stock for $50,000. And then, as we had before, the difference between the two, $60,000 minus the $50,000 is going to be paid in capital in excess of par value, but in this case, it's going to be preferred stock. We will go ahead, make this a little more even here. We're going to go ahead and credit that for the $10,000. Since we're talking about preferred stock right now, I just want to mention real quickly, preferred stock is going to have priority in the event of a liquidation. It will have priority over common stock as to distribution of assets. Something else, preferred stock is quite often cumulative. Preferred stock always has priority in dividends, but if preferred stock is cumulative, and it quite often is, that means you would have to pay, if you didn't pay, let's say, you never have to pay dividends. So let's say you don't pay dividends for 5 years, and you want to go ahead and issue a dividend to your common stockholders. You cannot do that if you have preferred, cumulative preferred stock. You can't do that until you pay these preferred stockholders the dividends you owe them for all those past years. So that's another feature if you have preferred stock and it's cumulative. But preferred stock always does, you have to issue those dividends first. I think that's about it. So hopefully that explains the chapter, and have a great week.